All right, moving on. So this is our awards-winning Bresa Excellence Awards. You can see this is a good track record throughout the years, where we have won many, many awards all the way from, 2017 all the way to just 2022. We won the first runner-up for the best retail derivatives trading participant, as well as the second runner-up for the best overall derivatives trading participant. All right, so moving on. So this is our global network. We are located in around 16 different countries, all the way from Western countries like, France, Turkey, Dubai, all the way to like China, Japan, and Southeast Asian countries like, obviously Malaysia, Singapore, and Vietnam. So what this means is that we have a wide global coverage, meaning we have access to products from exchanges like the CME Group, the Chicago Board of Trade, like Eurex, ICE Exchange, JPX, Holcom, SGX. What this means is that if you wish to trade any of the products from these exchanges, you can do so through us. We are that middleman. All right. So we are your one-stop solution for your trading because we offer many products, right? From futures such as index futures, agricultural futures, metal futures, all the way to stocks, such as Malaysian stocks, US stocks, Hong Kong, Singapore, Australian stocks, and also to shares contract for difference, things like Bursa shares, NYSE shares, NASDAQ shares, and US index shares, CFD. So we offer all of these products. So if you're interested in any of these, do stay tuned. All right, because we have some exciting news at the end. All right, so we are your broker of choice. Firstly, we are an award-winning multi-asset broker. We offer 24-hour broking and execution support. We also offer advisory services as well as the latest market news. And basically, you can learn with Philip Capital via our free one-to-one coaching sessions, free seminars and webinars just like these. And we also offer a very seamless free online account opening process, right? So basically what the free one-to-one coaching session has is that we have two sections. One is the product knowledge, where we bring you through an introduction to futures, CFDs, and stocks, and as well as the charting system coaching, where we bring you through a tutorial of our platform's coaching so you know how to use them, where to click buy or sell from, right? So if you are interested in our upcoming seminars and webinars just like these, you can scan this QR code to register for our upcoming events. Of course, you can also visit our website at flip.com.my. We also have the links there. All right, I'll stay at this slide for just a bit more before I skip to the next one. Okay, so next we have the weekly market calls. On the left, you have the market views and updates, where our analyst will present his weekly views every Monday at 11:15 a.m. And on the right, we have the live counter technical analysis, where our technical analysts will show you the weekly trends and potential entries and exits levels through technical analysis. So both of these are for free. If you are interested, they do happen every week. So just scan this QR code right here to save your slot. All right, moving on. So if you are interested in any of these, or especially after the webinar, you can definitely scan this QR code right here to save it. This is an online account opening process, which is hassle-free, extremely easy. But if you do think you will face some issues, definitely do reach out to me or my colleagues, and we will contact you after the event. Yeah. All right, so moving on, we have our multiple trading platforms. First off, we have our futures trading platform known as Flip Nova, where we have over 90 technical indicators. You can buy and sell directly off the charts, as well as the market depth trading tool for futures. We are on both mobile and desktop. So if you are interested, you can scan this QR code for a demo account, and you can also find our app on both the Apple App Store as well as the Google Play Store. All right, next, moving on, we have our newly refurbished stocks trading platform known as Poems Global MY 2.0, which is our platform that our clients use to trade stocks. We have our all-in-one stocks watch list. We have charting indicators as well as some other stock screeners like the exchange top 30 movers. So if you are interested in a platform with powerful stocks analytics, do try to find the app on the Apple App Store as well as the Google Play Store. And you do need an account with us to trade on this platform. So do reach out to us if you are interested in that later on. All right, next is our Flip CFD Trader, which is the platform that our clients use to trade CFDs. We have a friendly user interface. We have live charting as well as price alerts. So if you are interested in trading share CFDs with us, this is definitely the platform for you. All right, so we have our promotional part, right? So first we have the Trade Singapore shares, which is currently running from the 1st of January until the end of this month, where if you trade Singapore shares, you are entitled to win up to 200 ringgit Aeon vouchers. So if that interests you in any way, do scan this QR code for more information, or just reach out to me after the event. All right. So that leaves us to the core content of tonight's webinar. First off, thank you all for joining. It is a Tuesday night and it may not be easy for some of you to join, but thank you so much for coming. I'm your speaker and host, Brian. I'm the here at the Capital. So without, wasting any more time, I just want to get straight into the core content right here. So just a bit of the outline. First off, I'll bring you through an introduction of liquidity concepts right here, and then we'll move on to an in-depth study on liquidity pools. And then first off, we'll kickstart the actual strategy with something called the quality theory, and then that will bring us to our step-by-step approach, which is our trading plan, a mechanical trading plan. Right. If you have any questions, I will have a Q&A section at the end, so you can definitely just leave them in the chat for now, and I will answer your questions at the end of the Q&A. All right. First up, liquidity concepts. Okay, so what is liquidity? Well, simply put, liquidity is essentially buy and sell orders, right? So for a transaction to occur, you need to have a buyer and a seller, right? That's when a trade or a transaction occurs, right? Because you can't enter the market and buy something without someone selling to you at that price, and vice versa. You can't buy something if there is no seller, right? Second, in the financial markets, you are there either as a buyer or a seller, right? So buyers or buy side liquidity, they are people that place buy stops, place buy limits, or just market execute buy orders, right? They are no, they are known as buy side liquidity, right? Sellers, on the other hand, are sell side liquidity, right? Vice versa, they place sell stops, they place sell limits, and they market execute sell orders, right? These are the two sides of the liquidity theorem, right? So you may not know this, but if you enter a long, your exit is a sell. And if you enter a short, your exit is a buy. Now, this may seem, basic to a lot of people, but the big players, the people like the hedge funds, right? People like investment banks, they use this basic knowledge to manipulate the markets, right? Because if the big players, the people with a lot of money and capital, if they want to enter a large short, for example, they need a large quantity of buyers to sell to, right? They need someone to take the opposing end of their trade, which is only possible to have a trade in the first place. So it is in their interest to manipulate the market, quote unquote. Now, this is just a theory, right? I'm not saying this is exactly what happens 100% of the time, but we have seen kind of these occurrences happen within the market, right? Where people will always say, oh, they're taking shorts or taking buys and we're stopping us out. So we have to understand liquidity and the theory of it to be able to operate this trading strategy, right? So that answers your questions. Buy and sell, right? Buy side liquidity, sell side liquidity. But where do these liquidity reside? Well, here on the left you have a bullish candle, and on the right you have a bearish candle. Both of them, at the highs of these candles, is buy side liquidity, buy orders. And on the bottom of it is sell side liquidity or sell orders, right? So bringing you to this example, if in this gray box right here, we have an area of resistance, right? You see a price comes up to it, and then it kind of lingers around. It forms a double top, right? Suddenly it breaks lows, and people were like, oh my God, we came into resistance, we made double tops, we're breaking lows, we have to go short, right? If it comes back up here, we have to go short. So people are now eyeing, hold on, people are now eyeing this level right here to go short from, right? Because they saw price come up, make a double bottom, double top, and then we had a breakup structure. And when price came back to it, they're like, oh my God, triple top, I want to enter right here. So what they do is they enter a short, stop loss above the level, take profit somewhere down here, and then they got stopped out. Now, I'm not sure if this has happened to you, but this has happened to me many times at points where I don't think makes sense. So this kind of can be explained using this theorem right here. So remember, if you were a retail trader and then you wanted to sell here, your stop loss would be here. You are a seller at this level, right? Your stop loss would be above the areas right here. And remember, your exit as a seller is a buy order, right? So here we have a big area of buy side liquidity, right? We have the seller sell stops as well as breakout buyers buy stops. You know, the people that want to trade breakout, they have a buy stop set here. When price comes up to it, and then they get triggered, and they ride the market higher probably. So this is why we have buyers above highs, buy side liquidity. This explains it using traditional finance or traditional technical analysis, right? So this is a schematic. Let's move on to the real chart right here. Here you can see we have gold futures on a 1 hour time frame, and this is an area of obvious resistance, right? You see price came up, came down, made a low, came back up again, rejected, triple top. Goodness sake. After that triple top, the price broke this important low right here. So people were like, oh my God, triple top, sell, stop loss here, TP here, something like this. And guess what happened next, right? They expected the market to tank lower, but guess what happened next? The market came up to this area, and then we got stopped out. See how it wicked it like this high right here, it just wicked it. And then the market continued to kind of do this. Guess what happens next? Market tanked. We saw a large displacement or movement downwards. This is how the market entices you to get in. It wants you to get in here so you can put your stop loss on top here, which then causes the move downwards. Because if the banks want to sell at this area right here, they need buyers, right? Who's buying? Well, retail traders are buying right here. Buy stop losses or breakout traders, they're buying right here, and you get triggered in right here just by a bit. You know, it won't be a big move up or down. It will be an obvious move up or down, like really just quick, and then it just immediately tanks downwards. So this is just one of the examples of what I would call a sweep of liquidity or a draw on liquidity. And this is a bullish scenario. It's the same thing for a bearish scenario, vice versa. You know, to a bottom, we have sell side liquidity down here. Market comes up, takes these highs, and you're like, oh my God, we have to go long, right? Comes back down, stops you out right here, and then continues upwards. It's the same thing, just inverted. You know, it's just an inverted scenario. So basically what this means is that you see patterns in the market which entices you to enter prematurely, or for you to enter, put your stop loss, take profits, and then get stopped out by a bit, and then it reverses. This has happened to me many times throughout my years of trading, and quite frankly I never knew why until I came across this idea of market manipulation, right? So now that we know what liquidity is, right, it's kind of time to learn the different types of liquidity as well as how to spot them, right? Because if you can't spot the liquidity, likelihood is that you are the liquidity. This phrase right here, if you can't spot it, then you are the market's liquidity, right? Sounds pretty cool. All right, so first off, we have the first type of liquidity that resides around swing points, right? Swing points meaning pivot highs and pivot lows. These are areas that kind of like show you that really obvious zigzag movement upwards. Above swing highs, you have buy side liquidity. At swing lows, you have sell side liquidity. So this is the first type of liquidity pools. So see what happens when the market comes down below a liquidity pool. It has that obvious V-shape reversal to go higher. So this is when you know that the market has in fact taken out some form of liquidity, because it is a very quick in and out movement. Why is it quick in and out? Because the big players enter a large position in this area, which pushes the market upwards very, very quickly. That's how you can easily spot if something is a market manipulation or if something is a taking of liquidity right here. So that's the first type, swing points. Right now, swing points are fairly easy to spot, and I always tell my clients, just pick out the ones that are the easiest to your eyes, because those are probably the ones that people that trade support and resistance also put their eyes to. Just really obvious swing points right here. So just pick the ones that are the most obvious. Right, the second type of liquidity resides around equal highs and equal lows, or commonly known as double bottoms, triple bottoms, double tops, triple tops, stuff like that. So here we have an obvious example of on the gold futures 4-hour time frame as well. Here we have relative equal lows down around here, right? What are below lows? Sell side liquidity. See how the market came down, took this out, really quickly and really obvious V-shaped move right here, and the market displaced higher right here. So really obvious taking of liquidity. It's almost instant. You can really see how instant it is. It's just like a quick in and out move. This entire move down was super obvious right here. And we have a really straightforward target. These lows right here are suspiciously equal. So that's another form of a liquidity pool. This is a bullish scenario. Let's move on to a bearish scenario, which is literally just a reverse, excuse me, which is just an inverse scenario of the previous bullish scenario, right? Equal highs right here, market came up, took it, and then reversed, right? It's not rocket science, put it that way. So far we have had two types of liquidity pools. The first one is swing points. The second are relative equal lows or highs. And the last one, right, is the type of liquidity that resides around monthly highs, weekly highs, daily highs, or lows, right? So these are known as time-based liquidity. Why are they called time-based liquidity? They are called time-based liquidity because it is a high or a low in a period of time. Let's just say, for example, you go on any chart, right? Look at the previous month's high, it's going to be the exact same high, right, as anyone's high. You can look at a swing point and say it's a bit subjective, my eye see things a bit differently, but with time-based liquidity, everyone sees the same thing. And that's because time is a constant variable on your charts. 7:30 a.m. is the same for everyone, right? So time-based liquidity, in my opinion, they are the easiest to spot, but they are also the ones that give the biggest reactions, right? So think of it this way: a high of the highest point of that entire month is going to be very important, because in the entire month, nowhere in time they pass that high. So the higher you go from daily to weekly to monthly, the higher you go, the more important that level is, right? So that kind of gives you an idea on what to expect. So next up, we have an example here. We have previous week's high and previous week's low. So this was the entire trading week right here. So here and here. Look at the reversals and the reactions around the weekly highs and lows, right? This is gold futures on a 4-hour time frame. Look at how the market came up just above it and then tanked all the way down to target what? It tanked all the way to target the previous week's low, because remember, when the market sells, it has to buy it back somewhere, all right? And normally it buys it back at the opposing liquidity. So here we have buy side, here we have sell side. So once we take out buy side, we are going to rebalance the market by targeting sell side. That's how you find your buyers. The market isn't trending in a bullish or a bearish trend. It is simply seeking out liquidity from one point to the other. So that's kind of my example, right? So that was a weekly example on a 4 hour, but this is an example on a daily, right? This is daily high, this is a daily low. The market zigzagged up on the 15-minute time frame right here. Sorry. So daily high, daily low, and 15 time frame, market zigzag up, down straight into the opposing sell side liquidity. Now, don't take my word for it. Go onto your charts and see this on your own after the webinar, right? And just make sure you practice your eyes to see this enough, because these are the more obvious and easy to spot levels, right? So in this webinar specifically, I will be focusing on time-based liquidity because, like I said, it's easy to see, right? And it is kind of easier to teach, because teaching you how to spot swing point liquidity would be a bit hard because of how subjective it is. But time-based liquidity, it's constant. Everyone has the same daily highs, daily lows, right? So with this, we can formulate a very, very simple day trading model, all right? So that was the aspect on price, right? So now I will give you a strict rule on the time aspect of trading. It means that you will only be looking for a trade in this time window every single day, right? And this time window is based on something known as the quarterly theory. So the quarterly theory basically spans an interesting theory. Ever notice how 1 year has 4 quarters? 1 month has around 4 weeks, give and take. 1 week has around 4 days, because Friday has its own meaning in a trading week, which I will dive deep into next time. But for now, just understand that a trading week has 4 days, from Monday to Thursday, and each trading day has four main sessions, right? So 4 quarters, 4 weeks, 4 days, four main trading sessions, namely Asia, London, New York morning session, and New York afternoon session, right? So notice the similarities between these. There is an importance with splitting your time frames into quarters, right? Because the markets operate under specific market cycles each quarter, which means quarter one of the week, which is Monday, plays a specific market cycle and plays a specific role in that trading week. This could be a yearly cycle, a monthly cycle, weekly cycles, or just a daily cycles, right? So each each quarter plays a different role in the entire trading time frame, right? So if you understand that theory, splitting the time frame allows you to study specific behaviors of these cycles and allows you some level of predictability on the market movement. So it allows you to study and to predict certain market movements that usually happen during a quarter, right? As you need to notice that each quarters have its own use in the overall picture, like I just mentioned, all right? So this is the theory behind it, and it's a theory because it's not proven, like anything in the markets, it's not proven to work 100% of the time, but the accuracy is unreal. So there are a few time periods in a day which you should be looking at the charts actively. Now, in this example, I bring you to day trading gold because that was the whole point of this webinar, which is to allow you to day trade gold. And you want to be looking at the charts during these few time periods, right? And normally these time periods have high amount of volume and volatility, moving the market in a short span of time. And these time periods, are called market sessions. Now, the quarter theory doesn't operate under the normal market sessions as you may see in other maybe like indices sessions or forex sessions. This one operates a bit differently. So I'm going to lay out to you the time windows that you should be seeing at. All right, so we will be splitting the day, which is around 24 hours, or for some assets, for gold especially, is 23 hours, but that's fine. we'll be splitting it into 4 quarters. Each of these quarters are a 6-hour session. Okay, so these quarters or sessions are mainly the Asian session, the London session, the New York AM session, and the New York PM session. So one day, 4 main sessions, and the time periods are listed here, right? So sorry, this part. So the agent session normally has lower volume and movement. The rest are perfectly fine, which is why I recommend my clients to trade London, New York, or New York AM or New York PM, because normally open any chart, agent session looks like this most times, which is not really moving anywhere really, and you want movement if you're day trading, right? So remember, splitting the day into 4 quarters, and each of these quarters are a 6-hour session. So we will be basing it off of New York local time, which is Asia is from 6 p.m. to 12 a.m., London from 12 a.m. to 6 a.m., New York AM from 6 a.m. to 12 p.m., and New York PM from 12 p.m. to 6 p.m. Right? So here you can screenshot this or you can take a picture. But I've also translated it down to Malaysian local time for both non-DST, which is daylight saving, as well as daylight saving time. So right now we are in daylight saving, so do refer to this time frame down here, right? And remember, like I said, Asia has the least volume and movement on average. So if you are day trading, you want to day trade a time period that has large volume and large movement, right? And that normally happens during London, New York, and New York AM and New York PM. All right. So 4 trading sessions you can choose from. And all right. Yeah. So I'll just stay here for like 5 seconds and you can take a screenshot. All right, moving on. So we'll be splitting each session, which is 6 hours, again into 4 quarters, right? So it's quarter upon quarter. First it was one day, and now it's one session, right? So daily and session. So each quarter will be 90 minutes, right? So an hour and a half for each quarter. So for example, London session, right? From 12 p.m. Malaysian local time to 6 p.m., right? Quarter one starts from 12 p.m. to 1:30 p.m. Quarter two starts from 1:30 p.m. to 3 p.m. in 90-minute cycle. So this, leads from the previous one. Once this one ends, next one starts. So this is us splitting our sessions into quarters, right? So this is using London as an example. The next one is using New York AM session as an example right here. Same thing, 6 p.m. to 7:30, and then 7:30 to 9, 9 to 10:30, 10:30 to 12 a.m. This is New York AM session. And if I had to choose two, I would choose London and New York AM session if I had to choose 2 sessions to trade, because these two move pretty much the most from what I've seen and have experienced. So if you could choose to choose London or New York AM session, but there's nothing wrong with trading Asia as well as New York PM session. Just keep that in mind. Just choose a session that you can trade without any disturbance, and you can trade 100% focus. Right. So now that we have the time session locked in, it's time to move on to the best part, which is the mechanical step-by-step approach. All right. So the first step, whatever session that you trade, only take trades in quarter two, quarter three, and quarter four of any session, be it Asia, be it London or New York. Only trade quarter two onwards. Do not take trades during quarter one. Why? Because you will notice that when the session first starts, normally we have a big range, right? So normally quarter one will kind of have a rangy price action, which you will then notice in quarter two. We see this taking of orders or this market manipulation. Quarter three we see a reversal, and quarter four we see a continuation. This is what normally happens in a session cycle, right? You can see it in today's gold as well. So don't trade quarter one, trade quarter two and later, right? And if quarter one ranges and quarter two ranges, then you can expect quarter three and four to have a form of movement up or down, depends on your context or bias, but just stick with this for now, all right? So don't trade quarter one, trade two, three, and four, all right? Simple enough. So this is using an example right here. You can see quarter one, quarter two, quarter three, quarter four, right? So step two is when quarter two starts, mark the opening price of quarter two. So here we have quarter two here. It opened here at this price right here, the opening price. If you want to sell, you should be selling above the quarter two's opening price. If you want to buy, you should be buying below the quarter two's opening price. This is used as a filter for pricing. Pricing meaning you want to get in at the best price possible if you are a seller or a buyer, right? So once quarter two starts, mark the opening price, and these filters sell above here, buy below here, right? So that's the step two. Step one is quarter, step two is opening price, your filter for your trades, right? Third is look for nearby time-based liquidity. Time-based liquidity being your monthly highs, weekly highs, daily highs, or session highs and quarter highs or lows, right? So these are your time-based liquidity in order of general importance. And I say this because let's just say market is currently here, right? The market is here, monthly high is here. You wouldn't want to look for it to come back up here in just one day, right? So choose the ones that are suitable for wherever it is nearby. So choose the ones that are nearby, but also keep in mind that this is the hierarchy right here, meaning Monday is important, weekly is less important, daily is important, session, quarter. This is that hierarchy of importance. The one on top is more important, but they may be very far away. All right. So once you have identified these areas, wait for these to be reached and only trade when these areas are reached. So it's up to your own discretion if you want to choose any session or quarter or daily or weekly highs or lows, right? Session being Asia, London, New York highs, quarter being London's quarter one high, quarter one low, things like that, right? So I'll give you an example later on. This might be a bit confusing, but just stick with me, all right? So this is step three, look for nearby time-based liquidity. Step four, once these levels are reached, drop down to a execution time frame, which is normally a lower time frame, like the 5 minute, 1 minute, because remember, you are day trading, you are not swing trading, you are not investing, you are day trading. And the whole point of day trading is to get in and out without taking into account the bigger picture. You don't want to you don't care if gold flies up to whatever price tomorrow, because guess what? Your trades are in and out. You buy here, you exit here. It's really quickie. So this is the whole point of day trading. Drop down to your execution time frame. If we took out buy side liquidity, which are highs, you want to look for shorts. You want to look for a reversal lower. If we took out sell side liquidity, which are lows, you want to look for long. So if this is a previous daily high, right? What is above a high? Buy side liquidity. So buyers here, take it out. I want to see a really quick and obvious reversal downwards, right? And you have to make sure that we are in the right quarter and above or below Q2's opening price. So see here, this red line right here is Q2 openings price. I want to be selling above here and buying below here. So if I want to sell above here, are we above Q2's opening price? Yes. Are we in the right quarter? Yes. Quarter two, quarter three, not quarter one. Are we above a daily high? Yes. Did we see a reversal? That will lead to step five, right? But this is the step so far. Easy? I hope so, because this is as mechanical as you can get. So Step 5 is after making sure everything is correct, right? From the timing of the session to which side is being taken, we want to look for our entry on the lower time frames, right? And my entry model, which I'm about to show you right now, is called something which is known as a fair value gap entry, which uses fair value gaps. What is a fair value gap? This is a bullish example of a fair value gap. Now, you may or may not have heard of this, but basically it is a three candlestick pattern, meaning you have a one candlestick. So this is the first candlestick, second candlestick, third candlestick. For a bullish example, you want the high of the first candlestick and the low of the third candlestick to have some space, meaning you want to see one candlestick and then a big expansion candlestick, and then the third one, the low doesn't come at the high of the first candlestick. This then forms what we call a fair value gap or a market imbalance. So how you use this is once price comes down to it, you expect a reversal higher, and it will be tested, and you can look for long opportunities here with your stop loss below these lows, whichever you want to put for a bigger stop loss or a smaller stop loss. These are your entry models, right? Now, this is a bullish example. A bearish example is the same thing, just inverted. So first candlestick, second, third. This is the low of the first candlestick, the expansion candle right here, and then the high of the third candlestick. This leaves a bearish fair value gap. Stop loss around these levels, expecting the market to come back up to test it to go lower, right? So fairly simple, right? It's a as long as you remember three candlestick pattern with a space, an empty space between it. All right. So now I'll bring it to the last part, which is the inversion fair value gap. So previously we went to bullish, bearish. But what about an inversion? An inversion happens when we have a bearish FVG or fair value gap, for example, right here. Remember, market was supposed to come up into this bearish level to go lower, but guess what? It didn't do that. The market came up and then we closed above it. So if this is a 5-minute fair value gap, I want a 5-minute candle closure. If it's a 1 minute, then it has to be a 1-minute candle closure, right? Now, if we close above, it means we invalidate this level right here. And what happens, sorry, I think I kind of removed the share screen, but you should see right now. But basically what happens is once this area of resistance previously gets broken out of, we now expect it to come back and turn it into support, hence an inversion fair value gap. All right. I do see some of your questions, but I will answer them at the end. So yeah, for now, let's just stick to this. All right. So it's the basic concept of support become resistance, resistance becomes support after each of them fail. So here we have an example of on gold futures, right? So below here is the date right here. You can see it is from, this is during non-daylight saving. So it's from hours 1 p.m. to 7 p.m., right? So here is our quarter 1, 2, 3, and 4 during London, all right? Quarter 2 opening price right here. So selling above here, buying below here, all right? So see how price comes into this previous daily high, and then we take it right here, right? And apart from that, we form what? We form a bullish fair value gap after taking out, before taking out this previous daily high. So I want to go short, right? Now, because we took out buy side liquidity, timing is correct, we're within these quarters above the price, everything's correct. I want the market to showcase to me that we are indeed receiving confirmation to go lower. So market comes back into this fair value gap, bounces a bit, and then ultimately fails with this bearish closure, which invalidates the bullish fair value gap, right? Now, support right here, failed here. What does it become? Resistance, right? Support fails becomes resistance. So we expect this to happen now. So what you could do is you could have a entry right here at this failure, stop loss above, and entry take profit somewhere down here if you want to sell, of course, selling, right? um, but notice something within those levels. What is it? If you want to sell, you can also sell from a bearish fair value gap, right? So here we have a bearish fair value gap within this bullish inversion, right? So this whole area looking to short, and within it we can refine it down to this bearish fair value gap. So you now have a better entry, tighter stop loss, so a better risk reward ratio. So pure entry down here like this. See market comes back up, tags into it during quarter three. You can take profit anywhere you want, but as long as you take profit at a nearby sell side liquidity pool, seeing as this is a short, you want to target some of these lows right here. But in this example, I just used a previous daily low. Why? Because I took out a previous daily high. Ideally, I want to see price come back down into an equal opposing liquidity pool right here. And you can see how the market took less than a day. This is like during 5 p.m. MY time, and I think ended around New York session during 11 p.m. So this literally took less than a few hours. So it is a valid entry model, be it bullish or bearish. So the FVG entry model is valid for both sides, right? In the next example, I'll be going through a bullish scenario. So same thing, checklist, write it down. Session correct, London, all right. Quarter one, quarter two, quarter three, quarter four, trade within these three sessions, all right. Step three, Q2 opening price, all right. We are below it, so we want to buy, and then we are also taking out Asia session lows, right? So just because we come down below Asia session lows, which is a session low, it doesn't mean that we are just going to enter straight off here. Where is your confirmation that the market will reverse here? Where's your stop loss going to be put at? Those are questions you have to ask yourself before you even place that trade. So we are in this scenario and everything lines up, right? Now I want to see confirmation. Right here, market displaces. Hello, hello, can you guys hear me? Mic check, mic check. Can you leave a... All right, so I think you guys, I don't know what happened, but thankfully I'm back. So let me just continue drawing. Wait, can I draw? 1 second. Let me share my screen real quick. I do apologize. I'm not really sure what the issue is, but all right, we are back and we are stronger than ever. All right, so remember, everything lines up, and then we have a fair value gap form, right? So entry, stop loss, take profit, opposing side. So let's see what happens. Market comes down, tags the fair value gap, and then goes higher. Right? So This fair value gap is only invalidated if we see a body closure below it, and in these examples, they never went below it. So yeah, so it was never, the idea was never invalidated, so to speak. Can you see are there no slides? Can you guys see my slides? Is everything okay? Can you leave a comment down below? Okay, I think everyone can see my slides. Okay, so that was an example of a fair value gap entry. But Brian, what if there isn't any fair value gaps on either side? There's no inversion fair value gap. There's no bullish or bearish fair value gap. What happens then? Well, I'll bring you to my next entry model, known as the market structure shift model. Okay, so in this example, we have that liquidity up top. The market comes up, makes a swing high. The swing low is here. Remember, swing points are obvious ups and downs, all right? So those are swing points, right? So liquidity, swing low, swing high. Once the market breaks down below here with a candle closure, just enter straight at market execution, or you can set a pending order for it to return back to this level right here. Same thing here, bullish example, swing high, swing low, market displaced higher, taking out this swing high, you can enter straight at the level right here, stop loss below. Okay, so what that looks like on an actual chart is this, right? This is London session low. Okay, market came down below it, but notice how there isn't any fair value gaps. There's none on this side, none on that side, right? But what we do have is an obvious swing high, swing low. Choose the obvious ones. Okay, so here we will see that this is the only nearby fair value gap, and look at how far we are from that level. Normally, I prefer to be as near as possible, but there is none on either side, and this is the nearest one. So what we do is we take that swing high, and then we see price have a body closure above it. Now this example shows you the reality of trading. Sometimes, like I said, it doesn't always happen this way, but sometimes the market doesn't stop once it keeps going after an obvious liquidity grab. But here we have an example where price closed above this level, enter straight at that candle closure, target some other highs up top, stop loss below the recent swing low. All right, so see, this took a while to play out. I think this is a daily chart. This is a 1 hour chart, sorry. See, price ended up coming back into that previous daily high. All right, so moving on. So these are the two entry models that I have given to you. Now I want to take you to why this strategy is the way it is, or why do I promote it? Well, first off, it is a mechanical strategy, meaning it's a step-by-step process, right? It's it's easy to learn and follow, first off, which means that your decision fatigue is lessened. What this means is that you won't wonder if, oh, is this a trade? Is that a trade? I think it's a trade. I'm not really sure. But I'll take it anyway, and then you get stopped out, and then it ruins your whole day, right? So this won't happen because it is a step-by-step process, and because it is a step-by-step process, when you backtest and study, when you journal your trades, it is very easy to gather data that is accurate, and that is like as close to real trading as much as possible. Because when you backtest something that I call a discretion strategy, which is not step by step, it is kind of subjective. Some days you backtest, you might get a different results than other days, because even though you are the same person, every day when you open the charts, you may see things a bit differently. So what this mechanical trading strategy does is it saves your time on the charts, because you want to only be trading during sessions and quarters that make sense, which prevents you from over trading over risking, meaning you took one trade today in London and you took a loss. You can decide to stop there, or you can decide to trade during New York, which is New York core 3, core 4, or core 2. So this prevents you from revenge trading, and which in turn leads you to a healthier trading psychology. All right. So there are cons as well of this, which is because it is so step by step, it is very stringent and strict, and there's no flexibility, which means a person cannot make a decision based on market sentiment and condition. Meaning that even if fundamentally you think it might go down or up, if the model shows you something, you have to enter trade off the bat because that is the step-by-step process, right? And a person that did this strategy for 2 weeks is going to be as good as the person that's done it for 6 months, which means it allows no chance for experienced traders to execute their discretion, which may assist in profitability, right? So these are the cons of mechanical trading strategies. All right. So that is the core content. Here, I want to give you guys a special opportunity slash promotion, right? Or kind of like a service, I guess, which is the FCPO Daily Technical Forecast Group. FCPO stands for palm oil futures, crude palm oil futures, right? So basically, I have a group with my clients where I share daily markups of technical analysis charts, both long term and intraday perspectives, right? It looks like this right here. So you every morning at around 10 a.m. or 9 a.m. plus, you get a message from me with a full breakdown of today's trading day with the charts linked around here, right? So it's every single day that I send out this forecast. Right now, this is not a signal group. It's not a signal group at all, but this is just for educational purposes only, right? And even if you don't trade palm oil, that's fine because you can use the concepts that I show you here on gold or on other assets, on stocks, on share CFDs. You can use them in the same manner because it is just a technical strategy, right? So it looks like this. This is that broadcast group, and I'll share you things like breakdown of that day, like a market review. I'll show you why something happened, what trades you could have taken, like this right here. So this is what it looks like normally. And also in that group, I also share a lot more in-depth models, right, that I don't share to other people. For example, I leave them for my clients because that's where I can help my clients one-on-one. They can ask me anytime. Any questions that they have in trading, they can just ask me and exploit my time spent in the markets, right? So in-depth breakdowns, in-depth models of it, you can see right here. This is that the fair value gap example right here, and I'll just show it to you right here that this is what I do for my clients every single day, right? An example of that is this is a forecast sent just this month on the 4th of March. I sent this out in the morning. I'm not sure if you can see the time. It's just like 9:39 a.m. Right? I showed you that, hey, I'm looking for supports around these areas and resistance here. On the daily chart, this is on the, oh, sorry, this is the weekly. Sorry, this is the weekly chart. Sorry, let me just reverse back. This is the weekly chart, this is the daily chart, and this is the 1 hour chart. So I break down the markets through different perspectives. So even if you are a day trader or swing trader, you can still use these markups to support your ideas, right? So these are the forecasts sent on that day. So the review I sent out the next day right here, which is showcasing to you the potential trade opportunities right here that you may have missed for that day, as well as my thought process going into those trades. So I'm not giving you the fish, I'm teaching you how to fish because I want you to be a self-sustainable trader that you don't even need me anymore. You can go into the charts every single day and you can be confident in whatever markets that you trade in. This is to teach you that skill set. All right. So if you are interested, all right, and you want to join, it's very easy. It's free, right? All you have to do is just open an account with us, which gives you access to this group, as well as access to me that you can reach out anytime and ask me trading questions if you want to. All right, and also I also want to share with you guys something that is in the works right here. Let me just share my screen right here real quick. I want to share you, this is a project, which is a PDF that I'm working on right now. This is the first chapter, right? This is just the first chapter and we have like 30 pages already. So it's an in-depth breakdown of the strategies that I use and the concepts that I use right here. So if you are my clients, I will share this to you. But so if you're interested in joining my client base, which gives you access to me, as well as this kind of content right here, you can definitely leave a comment later on, or you can reach out to us later on after the event ends. Right now, let's get back to the. Wait 1 second. Let me get back to the presentation right here. So if you're interested in any of those services that I provide to my clients, do scan this QR code, or you can reach out to me after the event ends. All right. And you can also open an account through our website, which is flip.com.my. So yeah, flip.com.my. So you can contact us here. This is this is our website. This is our Instagram. And we are also on platforms like Facebook, YouTube, Telegram, and LinkedIn, right? So you can find us on those platforms. And this is my branch phone number. We are operating from 9 a.m. to 6 p.m. every single day. Not every single, but on weekdays and on days that are not public holidays. And if you are in Kuching, this is our address. You can drop by and you can find me or my colleagues there. And this is our email. If you don't want to call, you can drop us an email as well. But if you have any questions you want to address, you can send them to me right here, because this is the part for the Q&A section. All right. So I have a few questions, which is, I don't understand the buy side, sell side on step 4. How should I know if it was time to buy or sell? Once you take out buy side, you should immediately be looking to short to catch a reversal. Um, for when you know you should buy or sell is to look at step 5, which is the entry model. Okay. Next is, how do you quantify the time-based liquidity, as local day is different from US and London day? Not really. The day kind of starts around the same time every day at 7 a.m. local time for us. For gold, at least, it's pretty much the same. It's just different time zones. Maybe that's what you are referring to, different time zones. Yeah. So just make sure you are in the correct uh, time zone. You can always cross check with the New York local time, which at the moment is a GMT -4. All right, next up we have, what is the monitoring time frame for assessment of your setup? Normally I go from daily down to 1 hour down to 5 minutes, because my entry time frame is on the 5 minute. Next is, how useful is the volume profile in determining our trade? For this strategy, I don't use any indicators, so there's no volume profile. It is strictly just price action and candlesticks. All right, so how much do we need to open an account to trade? So for futures, you have to deposit a minimum of 1,000 ringgit, but that is not for the account opening fee. It is just to verify your bank details and stuff like that. And that 1,000 ringgit is able to be used by you to trade later on once the account has been opened. So for futures, minimum 1,000. For stocks, it's just 10 ringgit for the CDS account. The minimum investment for futures, if you want to open a trading account, is 1,000 ringgit. So yeah. All right. Which future commodity is easiest to trade? There's no easiest to trade. I think there are just pairs who are more liquid and more volume, like gold and palm oil is pretty liquid and pretty volume. So if there's no such thing as easiest to trade, they are all pretty much the same. All right. Do you have any other questions? If you do have questions that you want to reach out that you can think of right now, you can definitely reach out to me after the event, and I'll answer your questions. Yeah, just drop me an email or call into my office tomorrow morning. Anyone can open future account. Yeah, anyone can open a futures account as long as you are 18 and above. All right. So any more questions? Any more questions? All right. I think that is it. I'm not seeing anyone's pop up. All right. So thank you all for coming. Any questions you want to connect with me, I'll just bring you back to my. Again, if you do want to contact or reach out to me, you can find me right here. Save these slides and save this slide right here, so you can just reach out to me later on, and I can assist you the best I can. All right. So thank you for coming, and I hope this has helped you. I hope this has given you a trading plan, and I can't wait to share with you guys in the next webinar or seminar if you're in coaching. Heads up. But yeah, all right. All right. Thank you all. This is Brian from Coaching Branch for Fit Capital, and good night.